And it's a great pleasure to introduce Michael Schill from UCLA, who will chair the panel. Michael?
Thank you very much. You've had all the tricks today, so now we're going to give you the treat. And it's this last panel. Everybody's been wondering and talking about, well, what do we do? What do we do in this panel? Hopefully we'll get some very good answers to, or at least some indications of answers to that. So the structure of the panel is going to be the same as all of the others. Each of the paper presenters will have 20 minutes and up to 20 minutes, and then each of the discussants will have up to 10 minutes. And for those of you, I know some of you have planes that you've mentioned to me. We will end this panel at 5 o'clock, so it's a tiny bit on the early side, and but that'll be when we end. So why don't we start with Diana Hancock and Wayne Passmore. And Wayne, you're going to be presenting?
Yes, I am.
Okay, great.
Thank you very much. We're very pleased to be here. Our paper is titled 3 Mortgage Innovations for Enhancing the American Mortgage Market and Promoting Financial Stability. This is work by Diana Hancock and myself, and I want to be very clear that the views expressed are those of the authors and do not necessarily reflect those of the Board of Governors of the Federal Reserve or its staff.
Do you want a picture?
So I would show a more flattering picture, I think. It's, let's see. So I'm supposed to click that. So there are 3 objectives, at least 3 objectives, the 3 that we're focusing on here to government mortgage market policies. 1 is to mitigate the losses associated with mortgage foreclosures. 2 is to promote affordable home ownership. And 3 is to provide low-cost mortgage financing. Here we are looking at these objectives in light of a 4th objective to promote financial stability. So we're going to consider changes in mortgage contracts and to the structure of housing finance that might enhance financial stability. Okay. So we want to discuss 3 innovations that meet these objectives, the mortgage market policies objectives as well as the financial stability objective. And the 3 innovations that we want to discuss today are 1, buy your own mortgage options. This mitigates foreclosure costs and the associated externalities. 2, variable maturity mortgages, or VMMs. This is a way to try to promote an affordable mortgage without payment shocks. 3, the provision of a government bond insurance, or Insurer, with an emphasis on covered bonds. This makes a diversity of mortgage financing alternatives feasible and creates a level playing field for covered bonds, something we think is important. It also makes implicit government guarantees explicit. And our view is that these 3 innovations might help the mortgage market and mitigate systemic risks. So let me discuss the first innovation, buy your own mortgage, or BYOM options. So during the recent turmoil in the subprime mortgage markets, investors have dramatically marked down the prices of the subprime mortgage-backed securities. And in line with these lower MBS prices, many financial institutions have taken large losses on their holdings. A decline in the market value of the MBS implies a decline in the market value of the mortgages that back them. But homeowners, however, can still carry these mortgages at their par value. So American mortgage contracts lack the option to refinance your mortgage at its new market value. Ironically, in some cases, if the homeowner was able to recontract their mortgage at its market value, the homeowner's liabilities would decline and the homeowner's odds of default would decline. But in the current system of mortgage finance, it's difficult for a homeowner to refinance a mortgage at its current, that is, its market valued principal balance. Now, there are places in the world you can do this, and the most prominent one is the Danish mortgage market. In the Danish mortgage market, homeowners can purchase an additional option, the ability to prepay their mortgage at its market value rather than its par value. Like the prepayment option in the United States, this option is a one-sided option. When the market value of the mortgage is larger than the par value of the mortgage, the option is worthless. When the market value of the mortgage declines below the par value of the mortgage, the homeowner has an incentive to prepay the mortgage at its market value. The Danish market value option, purchase option benefits both borrowers and investors. The market value purchase option cuts both ways. It's valuable to the household because it gives them another mortgage prepayment choice, but it's also valuable to mortgage investors because it lowers the probability of default. In particular, households who must move because of job transfers, divorce, or financial difficulties and that have a house that have fallen in value below the par value of the mortgage may sometimes find it in their interest to refinance and pay off the mortgage at its market value. For these households, if their only option is to repay the mortgage at its par value, they'd be more likely to default, thank you, increasing the losses for investors in their mortgages. So there's very few studies of the Danish-style options in the United States. In fact, there's only one. It's Fitzup and Wilhelm. They use a standard option pricing model to calculate the cost of a market value prepayment option in the U.S. market. They estimate that this option would cost at least 50 basis points minus the decline in credit insurance costs associated with the lower probability of default. They also argue that the benefits of such an option would be greatest for low and moderate income borrowers. In particular, when mortgage rates are high and the unemployment is rising, many lower income borrowers might benefit from moving to a more secure, higher paying job. Maybe we close that. That would be. Oh, sounds like it's off the track. Sort of like my shower door at home. So no studies consider the market value purchase option in the current environment. In the current environment, with sharply falling home prices combined with rising unemployment, this is a new environment. Using the past to project the future is all the more difficult because of its lack of historical precedent. Regardless, we do know that the common structure of MBS in the U.S. makes it difficult to complete loan modifications with a write-down of mortgage principal. Thus, homeowners do not benefit even though the lender-investor has already written down the value of the mortgage. So let me give a brief description of loan workouts in the United States and why U.S. mortgages are usually kept at par. In the current system of loan workouts, it's complicated and costly. Loan servicers assess the willingness and capacity of each delinquent borrower. They may offer a temporary reduction, the servicers may offer a temporary reduction in mortgage payments, but even though the market value of the mortgage may have plummeted, the servicer rarely, if ever, will offer a delinquent borrower a reduction in mortgage principal. Even in the cases where a permanent principal reduction might be warranted to avoid recurring defaults by the borrower, the servicer may hesitate because principal reductions fall disproportionately on the higher risk security holders of the MBS, raising legal concerns about the disparate treatment of investors in the MBS securitization. Foreclosures are often seen by servicers as a better option because of the reduced moral hazard and the lack of litigation risk relative to writing down the principal balance. So what we're doing is thinking about the idea of Americanizing the Danish option. We actually like the Danish option a lot, but importing it would actually be quite difficult in many ways because of the way you have to structure the bond market. So we're now proposing something called buy your own mortgage options, or BYOM. It's the option to sell the home and give the proceeds to the lender to pay off the mortgage, or just to put the home back to the lender if you wish. The homeowner pays the lesser of the par value of the mortgage or the sale price of the property. The option can only be exercised if the homeowner actually moves out of the house, and the option is purchased when the mortgage is originated. So the options like prepaid foreclosure mitigation exercised by the homeowner. The homeowner avoids the foreclosure costs, including the possible legal consequences of walking away. The lender avoids transaction costs associated with foreclosure, and going forward, this might provide a method for the originate-to-distribute system to resolve defaults leading to foreclosure. That is, it allows a way to structure ex ante the cash flows. This allows homeowners who need to move to take a new job to do so, ending the lock-in effect of the par value of mortgage repayments. But now in pricing these things, mortgage down payment is key. Without a BYOM option, the lender and borrower fight over how to split the deadweight with foreclosure costs. With a BYOM option, the size of the down payment is the key decision. It determines the first loss position for the homeowner when the house price declines. With exercise of the BYOM option, the lender holds the second loss position if the house price decline is greater than the down payment. The lender has a strong incentive to encourage large down payments. Now, when you actually do some simulations about this, you can find out that sometimes, the BYOM option cost is negative. It's not really a surprise which parameters you put in, but if the foreclosure costs are high, say in our stylized example in the paper, 40% of the mortgage, and the decline in the house value is small, say 20%, the lender wants the borrower to leave and avoid the costs of the foreclosure. In practice, indeed, the lender sometimes does pay for the borrower to move when the home equity is negative. BYOM changes the mortgage contract to make this the borrower's option. The lender agrees to waive the right to foreclosure and instead accepts the market value of the home as the payment of the mortgage. So there's a financial stability rationale for why we're interested in these options. When house prices rise, home equity rises, borrowers may choose to increase their indebtedness by using cash-out refinancing. The financial accelerator kicks in and boosts economic growth because collateral is increasing in value. When house prices decline, home equity decreases. Borrowers may exercise the default option when the mortgages go underwater. As more borrowers default, house prices fall further. The financial deaccelerator is operating to slow economic growth, and the collateral value is decreasing in value. The BYOM option helps effectively break the financial deaccelerator because it effectively insures homeowners against large capital losses when there's a steep home price decline and significant unemployment. With BYOM, the employed borrower gets a true clean start during times when the economy is weakest. Employers might be particularly interested in BYOM if they want to expedite employee transfers when house prices are falling. So to give a brief summary of our first innovation, the BYOM options, first, there are substantial social externalities associated with foreclosure, and one practical action that might be taken in the short term is to modify mortgage contracts to include this prepaid foreclosure option. This option would allow borrowers to pay off their mortgage with the proceeds of their home sale when they move. This option doesn't look particularly expensive and may have significant social value because the foreclosure process is avoided. The second innovation I want to discuss, variable maturity mortgages, VMMs. VMMs are fixed payment mortgages. They hold the household's mortgage payment constant, but the maturity varies in response to changes in mortgage rates. When the mortgage rates fall, the maturity of the mortgage shortens. When the mortgage rates rise, the maturity of the mortgage lengthens. VMM provides the homeowner with nominal payment certainty without all the implicit costs of interest rate insurance that are embedded in traditional fixed rate mortgages. VMMs can be thought of as an ex-ante method of loan modification. Just like BYOMs are an ex-ante method of handling default and avoiding foreclosure costs, VMMs are an ex-ante method of modifying a loan when interest rates rise. Maturity extensions up to a point are automatic. Mortgage rates rise without the payment shock to the homeowner, but the homeowner gets a lower cost mortgage relative to the traditional 30-year fixed rate mortgage. VMMs lower default risk relative to adjustable rate mortgages because the payments don't rise, relative to traditional fixed rate mortgages because monthly payments are less. But VMMs do create significant interest rate risk for the lenders. And the problem is, how do we help the lenders hedge the interest rate risk and thereby provide a more affordable mortgage for some borrowers without the risk of payment shocks? So in VMMs, the mortgage's maturity can become very long. For a 6% mortgage, the maturity would rise to about 50 years when the rates rise to 7%. This suggests a need on a cap for maturity the lender would have to bear and price in the mortgage contract the risk associated with negative amortization should mortgage rates rise a lot and the maturity hit its cap. So if we had VMMs with cap maturities, lenders would need to hedge interest rate risks. Like a traditional 30-year fixed rate mortgage, the borrower would implicitly pay for some mortgage rate insurance by paying for a higher mortgage rate. With a VMM, the borrower would bear the risk of limited increases in rates by increasing the maturity of their mortgage rather than in the payment. The lender would bear the costs of hedging the remaining interest rate risks associated with more extreme movements in rates. Even with a maturity cap, VMMs are easier to offer when lenders have access to longer-term funding for mortgage financing. So that's going to cause me to detour a bit here and talk about longer-term financing of mortgages in the United States. So Fannie Mae and Freddie Mac debt is traditionally one source of longer-term mortgage financing. It's an important consequence of their implicit government guarantee. Home loan bank advances are another source of longer-term mortgage financing, again, an important consequence of an implicit government guarantee. Insured deposits are an important source. This time the government guarantee is explicit through the FDIC. And Fannie and Freddie guarantees on MBS make it easier for the private sector to finance mortgages over a long horizon, another implicit government guarantee at work. So our third innovation is a government mortgage bond insurer. A government mortgage bond insurer makes implicit government guarantees explicit. It ensures all government-encouraged debt used to finance housing. It creates a diversity of longer-term funding sources for mortgages, including covered bonds. And we want to discuss covered bonds because covered bonds have been a robust source of mortgage funding in many countries. Established covered bond programs in the United States would enhance financial stability. And of course, the chairman talked about some of that earlier today. So let me talk briefly about covered bonds and give you a brief description. It's a debt instrument secured by a perfected security interest in a specified pool of collateral. It provides funding to a depository institution that retains a covered pool of mortgage assets. It's the major source of mortgage finance in Europe. It's more robust than mortgage securitization during the recent financial market turmoil. And like GSE debt, it's typically sold to yield investors who do not want to conduct due diligence for credit risk. So I want to dwell on that because of some of the earlier conversations during this conference. So there's been a lot of discussion about opacity versus transparency and in the creation of securities backing mortgages. And I think that is one element of it, but not the full story. When you aggregate up mortgages and turn them into securities, you're trying to create a generic, large volume security that can be traded widely. And what you're trying to do actually is bring into that market what we call yield investors. There's a lot of names for what you want to call these investors, but the reality is what you're trying to do is sort of cross a boundary from investors who are willing to pay for due diligence to understand the underlying mortgages to investors who really don't want to fool with that stuff, but just want to know that they're trading a relatively riskless asset and that they can either hold or trade that with a lot of certainty with a lot of other people because there's a lot of it and it has homogeneous characteristics. Okay? So how have we done that in the past? Well, okay, one example were CDOs. Took mezzanine tranches of subprime securities, bundled them together, produced something that was AAA rated, and it traded well for a short period of time. But then, when problems erupted in the subprime mortgage market, all of a sudden all those yield investors say, boy, I guess I'd really need to know something about those underlying securities, and in fact, I'm going to stop trading this stuff, and I don't really want any more of it. Okay, so that was a case where the monitor of that system, i.e. the method by which the AAA rating came about and the credit rating agents themselves, those yield investors lost confidence and you effectively had a run on that type of structure. Same thing happens with the GSEs. The GSEs, you see an unfolding housing crisis in the United States. Yield investors start getting anxious. They see capitalization look pretty low. They see capital look not too high quality, things like tax-deferred assets. And they begin saying to themselves, boy, do I really understand what's behind all this? You know, I think the government insures it, but, you know, I'm not really sure. It's implicit. And and then what happens? Well, as the chairman discussed briefly today, you start seeing elements of a run. People begin saying, gee, I don't really want to hold this short-term debt all that much longer. I'm looking for ways to diversify away from that. And you ask, well, all right, how are we going to offset that? Well, in the short term, the way we've offset that is by enhancing the government guarantee of GSE debt and MBS. And as the chairman mentioned today, it's very important we maintain that government backing. But as we discuss how to modify the markets going forward, this is how I view this question of opacity and transparency and the like, which what you're really asking is how do we create a security that can be sold to yield investors that they can have confidence to trade it and give you those economies of scale and those liquidity benefits and that cheaper financing that we're trying to direct to housing without creating financial stability problems or the possibility of runs. So that's a lot longer on that bullet point than I intended to spend, but let me keep going on with covered bonds. Covered bond investors have recourse to the issuing bank as well as the underlying collateral, the so-called covered pool. Covered bond assets remain on the issuing bank's balance sheet, and the bank actively manages the covered pool and has strong incentives to appropriately manage the credit risk. And this is a key difference between this and the standard originate-to-distribute system. The bank is managing the pool and has it in their interest to manage it well. Covered bond investors all have the same priority to cash flows and underlying assets. And none of the securities have different priorities or claims. They're simple. So covered bonds in the United States, unlike in Europe, there's no separate legal or regulatory structure. A contractual structure, the Uniform Commercial Code, provides standards for pledging assets. Now, the FDIC has accommodated investors to some extent on how to deal with defaults with covered bonds. They've recently passed or promulgated some regulations to deal with this. And the Treasury has recently encouraged best practices for depository institutions. So the Federal Reserve, the Treasury, the FDIC, we all see that there's that there are benefits to covered bond markets. Despite these efforts to provide a framework for covered bonds, they have been difficult to jumpstart in the current environment. Well, let's talk about covered bonds and the relationship to GSEs. Covered bonds, GSE debt, Ginnie Mae securities all compete for the similar group investors, these yield investors. Covered bonds compete with GSE funding, particularly the home loan banks who use the mortgages as collateral. And the government, in a sense, has now created a number of overlapping government-backed mortgage financing institutions. So it's difficult to establish a new instrument like covered bonds in a heavily government-backed market, even if there's some significant advantages. So let's return to the third innovation, a government bond insurer. We propose that a government bond insurer explicitly insure the financial instruments used by institutions it sponsors to provide mortgage credit. It's like deposit insurance. There, or in deposit insurance, the FDIC explicitly charges for a government guarantee. It charges risk-based premiums and establishes a reserve to cover expected losses for the multitude of government-backed housing financed instruments. So in our case, in our proposal here, or our idea that we're trying to throw out to get discussed, is that the role of the government bond insurer would be to insure the debt of Fannie Mae, Freddie Mac, and the home loan banks, to insure Fannie Mae and Freddie Mac MBS, and to insure mortgage-backed covered bonds issued by depository institutions. There are 5 advantages to this idea, this framework. 1, it assures that similar risks are treated similarly for different government institutions to help make mortgage credit available. 2, it provides a substitute for the market discipline that's lacking in implicitly insured mortgage government debt. 3, it enhances financial stability by providing an explicit government guarantee for mortgage-related debt during bad economic times. 4, it increases the ability of depository institutions to issue and hedge long-term mortgage debt, including mortgage-backed covered bonds, something we have an interest to because we're also trying to get a variable maturity mortgages discussed. And 5, it's consistent with the diversity of financial instruments and a wide range of institutional frameworks for mortgage finance. This doesn't actually opine on the structure of GSEs. You could have the current GSEs, you could have more GSEs, such as the Chairman Greenspan, former Chairman Greenspan has promoted. You could have the sort of scenarios where there's constraints on portfolios. You could have covered bonds. Regardless of how you do this, you have an insurer who basically tries to equate these various instruments and their risks and price for it explicitly. So in conclusion, there's 3 innovations. Buy your own mortgage options lessens the social risk costs of foreclosures. Variable maturity mortgages help make mortgages affordable without payment shocks. And a government mortgage bond insurer resolves the systemic risk of government-sponsored mortgage financing and increases the diversity of mortgage financing vehicles by encouraging a new robust fund of mortgage finance in the United States to insure covered bonds. Thank you very much.
If during any conversations I may have had with anyone today, if I made a mistake in my understanding about money and banking, it is because our next paper presenter obviously failed to teach me when I had him 30 years ago for money and banking. So the next presenter is Dwight Jaffee.
Your students do come back to haunt you, don't they? Let's see, let's get going. Okay, the paper is regulating the investment banks and GSEs after the subprime crisis. So I think it's suitable at the ending here to have a notable optimism that this too will end, and I do believe it will. And in fact, I think as a practical matter, whichever party wins, I suspect Washington, D.C. in January or early February is going to be a hotbed of proposals for re-regulating the system, and I wanted to put my candidate in the list early. So what I'm going to do now is offer a framework and a proposal for the re-regulation of the investment banks, and I would include AIG in that set, as well as the GSEs. As I started to talk to people about this topic, I came to realize that while I thought it was sort of simple and obvious that we were going to re-regulate them, there are others that have given me some pause. So I want to make the case that there's a long historical precedent in the United States, and a very successful one, that we have innovations that very often create crises, and we re-regulate afterward, and that the list of re-regulations that have come into play are incredibly successful. That the re-regulations are focused on the problem, they solve the problem, they allow the inherent efficiency of our capital markets to be retained. We still have them as a good example. level, and they generally are very successful sort of dialectics. So I've created in the paper a little list. I won't spend any time going over the details here, but you can go back as early as the National Banking Act of 1862, which created national banks, and you can go all the way down to the Fiducia of 1991, which created prompt corrective action in the aftermath of the S&L crisis. Probably the most contentious item on this list is GlassSteagall, and indeed it's very central to my proposal, so rather than comment on it now, I'll come back to it and discuss how GlassSteagall plays a role in my views about it. So executive summary is I'm going to start by asking two questions, because if we're going to get a solution, we need to know what the problem is. And so one question is, what did cause the subprime mortgage crisis? A second, and equally important, in fact, in a way, the fundamental question is, what motivated the Fed and the Treasury to have to carry out bailouts? After all, we've had a number of recent crises. Long-term capital management failed, and the government needed to put not a dollar of taxpayer money at risk. The fundamental driver of my proposal is that the goal is to create a regulatory system in which there would not be any future bailouts of this form and for the reasons that we just saw. So that's my primary goal. Of course, I have sub-constraints that I want to maintain an efficient system. I want to maintain a system that's open to future innovation. But I first and foremost want a system that's robust, that a year from now or 10 years from now, we will not have a replay of the same. The analytic framework that I use, the method here is to recognize that both the investment banks and the GSEs basically have been operating with two divisions. One, which I call the hedge fund division, which creates a highly risky, leveraged, maturity mismatched portfolio. And that's what's failed in all of these firms, and that's what's created their losses. And a second division which carries out much more of a social market activity, what I call the infrastructure division. Within the investment banks, you can think of this primarily as their counterparty desks, which is the given reason that given by the regulators why they bailed out the banks, because they were worried of the systemic risks that would be created by a failure in the derivatives market. And in Fannie and Freddie, it's the fundamental mission they have to support the mortgage market. So that's the infrastructure division, these hedge fund divisions that they each have, the retained portfolios for Fannie and Freddie, the investment portfolios of the investment banks is what I call the hedge fund. The proposal is driven by recognizing that we've had two very successful lines of regulatory structure in the United States that I would generally call monoline. Some of you may know I've been doing a lot of research in the last 10 or 15 years on catastrophe insurance. Most of the major catastrophe insurance companies are monoline. In fact, they're monoline by law. It says that they cannot own two different insurance activities. You can only do one thing, and the idea is that there's not a contagion if this catastrophe line goes bankrupt. And of course, with catastrophes, you can never hold enough capital, so that is always a possibility. It doesn't bring down the rest of the enterprise. GlassSteagall, as I'm going to show you in a minute, is a very similar concept of monoline, and what I want to do is apply it in a modern setting into our current institutional context and create a re-regulation of our system along these lines. But let me start at the top. First of all, the sources of the crisis. Of course, the proximate cause are subprime mortgages. I'm not going to belabor the long discussions we've had of their design and their execution. I would say that the re-regulation, certainly of the predatory aspects, is virtually done. And if you haven't looked at it, in late July, the Federal Reserve issued new truth in lending regulations. And to my taste, had they been in place in 2001, we wouldn't be sitting here. The key provision, and it's one John Quigley and I have written a couple papers on related topics that we had recommended, was a suitability requirement. Just as if you want to trade risky options at your local stockbroker, they're going to give you this long financial test, and they're only going to allow you to trade if they view you as suitable, and they have to do it. The new Fed's truth in lending laws for subprime mortgages requires the lender that the lender impose a suitability test. And not only that, it says the appraisals must be done by honest third parties. There's no longer liar's loans. They have to be fully documented. The rules are really written very well. I had thought maybe they took the idea from us. Someone has told me, though, that actually was sitting in the drawers of the Federal Reserve since 2001, and it just hadn't seen the light of day till recently, so maybe not. Anyway, we've had plenty of discussion of loan modifications. I will only say on the hope for home ownership, there was in my view, is an outstanding study that was done just before the legislation was passed by the Congressional Budget Office that is worth having a look at. What it shows is that, to the best estimates, and they're only estimates, of course, there's a 1% subsidy rate that's built into that program. And what's important to recognize is any program that's going to do any kind of a loan workout, first of all, it has to compete with Hope for Homeowners because it's out there. And the best you can probably do is a 1% subsidy rate. I think many of the plans that are being proposed, if you want to know where's the rub is that you need somebody to take out the loan at the end, and if that loan has a high default risk still inherent in it, you can't pretend as if it's going to be issued at the prime mortgage rate, and that's a cheat if you do. So that's the warning. The CBO paper is very good in that respect. One other point to make on the subprime mortgages themselves, and again, some have made it, but I think I have a slightly different spin, is how big of a deal is this? And here, I did some back-of-the-envelope estimates. So and these are upper bounds. If anything, I'm exaggerating the size. Maybe there were $2 trillion of subprime loans. If you estimate what is the total amount of investment assets, financial assets available in the United States, it's about $50 trillion, about 25 trillion of stock market equity, and about 30 trillion of debt. So as a share of the total investment portfolios in the United States, subprime loans represent about 4%, 2 trillion over 50 trillion. If you then say, okay, that's the size, what's the expected loss? I think, again, an upper estimate is 50% of these loans might go into foreclosure, and the expected loss given default is about 50%, so you could expect a 25% loss rate. Now let's think of, we've distributed them, let's say, diversified perfectly across all portfolios. So we're going to now look at the representative portfolio. You have a little bit of it, I have a little bit of it. What is the loss that we're going to suffer? Well, the answer in these numbers is we're going to have a 25% loss on 4% of our portfolio. That's a one-time hit of 1 percentage point. And to my taste, at least, that is not a very big number. You would not expect that that kind of a loss, had that been distributed across the entire system, would bring the world's biggest financial banks and sovereign funds to their knees. So obviously, there's more to the story. One part, and I won't spend a lot of time on this because you've had so much discussion of it, but we've obviously just had an extreme real estate cycle. To those of us that work in real estate, of course, this is not news. These cycles occur regularly. It's truly an open question why it is that people don't start to anticipate that the crash has to occur as the divergence between the market price and the fundamental affordability becomes more and more clear, but it is truth to be told, it happens every time. I think one interesting research project that I'm thinking about is whether we shouldn't really accept this as a market failure and start to say it's maybe some government action should be taken. In the very broad case, it could be the Fed could have done something about it. We may even want to have a more specific instrument, but that's sort of beyond the paper. The third, and what I think is a very key, each of these factors I think is necessary but not sufficient. So you need all of these things to basically have lined up. But the really critical one is that these mortgages and mortgage securities were not widely distributed in a diversified set across all holders, but rather in a remarkably small number of investment bank and GSE portfolios. As I've said, these portfolios were about as risky as you could make them. They started with subprime loans. They then bought the riskiest tranches of securitizations that had them. They leveraged them up 30 to 1. They mismatched the cash flows, and no surprise in a way when they've now had a shock that perhaps surprised them that house prices across the nation fell. This did exceed the capital, or very close to exceeding the capital of the investment of the banks. In fact, it appears that they weren't truly insolvent, that on a mark-to-market basis, most of them still had some capital. If you look at the testimony that Cox gave after the Bear Stearns bailout, he said, Friday afternoon, they had 13 to 14% capital, i.e. their assets exceeded their liabilities by 13 to 14%. AIG, they're still claiming it's fundamentally sound. We're just got to liquidate it. So what happened in the crisis is that firms that were on the margin of solvency, but probably were still in the black, the market got very worried, and what transformed became a liquidity crisis. And that's where these mismatched portfolios had to pay the price, that they had billions and billions of dollars of cash flow coming due, and the market simply wouldn't lend to them. And that is enough to put you into bankruptcy, and that's the stage at which we have to ask, and now why did the Fed bail them out at that point? But that's where the threatened bankruptcy comes from. Two red herrings here, and my heart sank when I heard Chairman Bernanke's talk start with securitization, because that's one of what I consider to be a red herring. It's a diversion from the issue at hand. The argument that people use is that the securitization channel allowed the originators to make bad loans and everyone just passed it on happily along. Well, there's got to be a final holder. As it happened, moreover, the final holders in this string were the most sophisticated, largest, wealthiest, best-informed investors in the world. If they thought that this was bad stuff, they wouldn't have bought it, and the whole process unravels. So to me, the idea that there's a chain here of passing on the hot potato and that that's a failed concept is just wrong. Those investors knew exactly what they were buying. They thought they were profitable. They may have made an investment mistake, but you wouldn't shoot the instrument. You would shoot the strategy at the banks or the investment decisions they made. I think it's really dangerous to blame it on securitization. It provides a very fundamental benefit to the U.S. economy. It's the way money gets from Main Street to Wall Street, and in which we then allocate it. The riskiest tranches can be allocated to those investors that have the greatest tolerance, and to, in any sense, throw it away and say it was the fault here is really misguided. So I hope that doesn't happen. The second sort of red herring are the credit rating agencies, and of course it's become absolutely fair game to roast them in front of Congress, and everyone has a lot of fun. The truth is they made a terrible mistake. The mistake they made is they didn't realize that a 1 in 80-year event of a significant aggregate house price decline in the United States was going to occur. You could say that they should have done better than that. But I would tell you, if you start to think about it a little bit, put yourself in their shoes in 2004, where we had just gone through the dot-com bust. A lot of subprime mortgages defaulted, and it was all FICO score. And so what they did is they raised the standard of FICO scores. The FICO scores on subprime mortgages improved every year, 05, 06, 07. But when you do a risk rating, it's a weighted average, and if you put more weight on FICO, you're putting less weight on something else, and they got caught. Anyway. So but let me get to the main track here. Why did the government bail out these institutions? And I've already suggested it is because they thought that the infrastructure division at Bear Stearns or at AIG, the derivative desks, or in the case of the GSEs, I think it's because of the fundamental support that they provide to the mortgage market, that this was endangered if the firms had gone into bankruptcy. And you have to understand, if these firms go into bankruptcy, the government no longer has much control. They're now in front of a bankruptcy judge who is under law to liquidate the firm, and all of the bankruptcy aspects come in, including the deadweight costs. The government couldn't let that happen, or at least that was the fear they had with Bear Stearns. It was the fear they had with AIG, and it's clearly the fear they had with the GSEs. The GSEs even represent a somewhat stronger case because in addition to being the world's largest counterparty in interest rate derivatives by a large margin, they of course had $5.5 trillion of capital market obligations on agency bonds and MBS, which part of the world was assuming had an implicit government guarantee. And so had that failed, it would have really been traumatic. So that's why they bailed them out. Now I'm going to turn to the solution here, and let me give you just a little primer on monoline insurers. So monoline, as the name suggests, it's where an insurer only provides one line. However, it's a little complicated because there are bank holding companies which can either have a portfolio of many monoline subs or even a portfolio with multi-line and monoline subs. What the monoline requirement means is that each of these subsidiaries has capital that's dedicated to paying claims on that line alone, and it really can stand alone. The rest of the company could fail, and that monoline would be just as strong as it was anyway. The monoline could fail, and it would have no repercussions for the rest of the firm. And that is well embedded in insurance law. Because it started with the private mortgage insurers, which existed in in the 1920s. They failed, but in 1956, I think, the MGIC was created under Wisconsin law, and what the Wisconsin legislature said in its wisdom was, you can create this new insurer again, but we don't want any contagion. We don't want a failure in this new insurer to bring down a auto insurer or a homeowner insurance. So we're going to impose on it a monoline requirement. We also impose on it a very heavy capital requirement. All their earned premiums must be held for 10 years before they can be distributed to shareholders. And that is the reason why, remarkably in a way, we have not yet had a failure of a private mortgage insurer. You would think they would have been the first to go. After all, they're the ones that are insuring the blasted stuff, and yet they're still standing. Again, as I guess Bob Hall kept saying, there's no forecast here, and tomorrow could be different, but it is impressive, and it attests to two things, really. They're not leveraged, and they're well capitalized, but if they were to fail, there would not be repercussions, certainly not within other insurers. Let me now turn to the other version of monoline that we have, which is GlassSteagall. And this audience knows, of course, that it was created in 1933 to separate commercial banks from investment banks. The key wording in that legislation is a commercial bank is allowed to carry out only a banking business. That's in the law. Court cases have considered what do those words mean, and the basic idea is a commercial bank can issue deposits and make loans. End of story. And that's in the law. Obviously, this is restrictive, but that's the way it was in 1933, and I think it worked well. By the time we got into the early 50s, the banks were saying, you know, we need a little more power. We want to run a Brinks truck subsidiary, or we want to do this subsidiary. These are activities closely related to banking, and Congress obliged. And another interpretation you need of this dialectic that's occurred in U.S. regulation is it's flexible. When the strong form of GlassSteagall had outlived its usefulness, Congress met and they passed a version that expanded it, that eased it. What the 1956 Bank Holding Company Act said is we're going to create bank holding companies. They can hold one or more banks, and in addition, they can carry out at the holding company level activities closely related to banking. And the Fed was given regulatory power to decide what is closely related to banking. They were timid. They started slowly, but over the years they expanded. The list was ever expanding. The one thing the Fed wouldn't do is either allow any bank holding company to own an investment bank nor to own any insurance subsidiaries. That was what was seen at least as going too far. But that became an increasing pressure from the banks as the European banks became universal banks and were fully diversified between commercial and investment banking. The American banks were saying, we can't compete. And again, Congress obliged in 1999, passing the Financial Services Modernization Act. And it basically said that within the holding company structure, banks could own investment banks and insurance companies, and many of them did. But there's two clauses. Sometimes this is interpreted as repealing GlassSteagall, and that's not fair because there's two sort of strong aspects of GlassSteagall that remain in the regulation. The first is that the Fed must regulate the bank holding company to the highest capital standard. So you can't be running loose on this. The Fed is going to be watching carefully. And secondly, the holding company is operated to protect the individual subsidiary banks. So you can do things up at the holding company level, but if they start to endanger the bank, they're not going to let you do it. As an example, you can always downstream capital from the holding company to the bank. You need permission to upstream dividends from the bank up to the holding company. So it's a pyramid in which the commercial bank is still protected, but within the holding company structure, we get the benefits of diversification. 2 minutes, great. Let me get to the two proposals. The first is re-regulating the investment banks. And basically what I want to do is go into these banks and say, you can run a portfolio that's as risky as you like, and we're going to call that your hedge fund division, but it's got to be isolated in exactly this monoline sense from the infrastructure divisions. They've got to be separately capitalized. The infrastructure division has to be capable of standing on its own so that if the holding company fails because the hedge company just imploded, we can just spin off this counterparty division, and it can continue to operate tomorrow just as well as it did yesterday. And the obvious benefit is that there would be no need to bail out anybody, that these investment banks would be operating and have no more claim to government bailouts than any other hedge fund in the economy. The fact that Goldman Sachs and Morgan Stanley have opted for bank holding company status actually makes this even more imperative, because we need to protect now the bank holding company, and in fact it's under the Fed's edict that it must protect the underlying banks, and this is to me the obvious natural step, as we've now seen how risky the investment banks are, to impose this kind of restriction on the investment bank divisions within the bank holding companies where they all are now. Finally, let me turn to Fannie and Freddie, and this is going to be the most contentious, I suspect, because I couldn't help but hear what Richard Roll had to say about the GSEs at the lunch table. So let me emphasize the first sentence in this page, which is the government-sponsored enterprises is a failed concept. And I really believe that, and that's sort of the bottom line. Let me give you a proof by contradiction. Let's assume the opposite, that they continue and that they do get put back out there in 2 or 3 years and they're functioning just as they always have. First of all, we have to understand the implicit guarantee is incredibly strong in that case. We've just gone through a case in which the government has announced, don't think of it implicit, it's virtually explicit. If we spin them out again, it's explicit. I mean, you've got to know that everybody is going to think it's there. The bondholders are going to assume they would be bailed out, so they're going to have no market discipline over these firms. Second point is the management, and in my view, has always been profit maximizing and have done an extremely good job. And the third, and this was mentioned in the conference, what would a profit maximizing management do under these cases? You move up that risk return curve as high as you can get. You make those portfolios as big as you can, as risky as you can, assuming all positive NPV investments, so you maximize your returns and the downside is covered by the US taxpayers. It's a formula for disaster. The disaster occurred and we don't want to go there again, in my view. So how do we re-regulate them? Well, very simply, I think we have a wonderful model in the FHA and the Ginnie Mae. FHA has been running since 1934 as an actuarially sound insurance company. They make risky mortgages, they guarantee them to the market, and they charge an insurance premium, and over, 100 years, 70 years of history, they break even. In fact, they must be actuarially sound because Congress requires that if there is a subsidy built into their pricing, they need a congressional appropriation, and they don't want to go there. So they actually require that they set their prices to be actuarially sound. Just as a side point, Ginnie Mae, which is the securitization version, runs with an office of like 3 people sitting in HUD because it just takes these mortgages, puts them together, and issues them out there. Our old colleague here in the hospital in the real estate group, Sherman Maisel, created Ginnie Mae, so we're very proud of that. This is what I would do to Fannie and Freddie. I would make Fannie and Freddie a single entity and keep them inside the government as an agency, and they would become the FHA equivalent of for middle-income borrowers what the FHA is for lower-income borrowers. And you could either just expand the Ginnie Mae program or create their own, you pick another letter, I suppose, but you would take those now government-guaranteed mortgages, securitize them, and you've now protected the middle-income part of the American mortgage market. I would say, and just closing that, in terms of the paper we just heard, that this is not all that dissimilar from the government insurance contract. Note, just as they had the government insuring the mortgages in the end, so do I. We'd have to look carefully at the subtleties of where the entity is sitting, and is there a big difference between whether the mortgages are inside the government or the guarantee is inside the government or not. I think they're actually very similar. I suspect we're on the same page. Thank you.
Okay, our first discussant is going to be Richard Green.
Well, it's a great honor to be part of this conference that has so many people, both on its panels and in its audience, whose work I've admired for many years. The way we decided to discuss this is, at Richard's suggestion, we're splitting this up. I'm going to talk about Wayne and Diana's paper, although I will make a few comments about Dwight's, I'm sorry. Richard is going to largely focus on Dwight's paper, and then Larry White will summarize, I guess, the whole conference at the very end. So principally, I'm going to be speaking about Wayne and Diana's paper. Let me start by saying this paper was a lot of fun to read, and it presented the idea, the reforms, extremely well, extremely clearly. But as a discussant, I have to, of course, find something wrong with all of them. I will say, however, that basically my attitude toward their three ideas in order is I don't particularly care for the first one. The second one may be okay. The third one I like kind of a lot, and I'll talk about why. And then I'll have some summary remarks about GSEs, the subprime crisis, et cetera. Okay, so they discussed three policy proposals. I love the titles, BYOM. I just thought bring your own milk is sort of what I think of when I see that. But buy your own mortgage, variable maturity mortgages, and covered bonds. Okay, the thing about the buy your own mortgage is it's a simple idea of a one-sided option, very similar to a prepayment option, but there's one big difference between the two that I think is really important in terms of the viability of this relative to basically interest rate protection if interest rates fall. And that is borrowers have no control over interest rates. So if you're giving a borrower a prepayment option and interest rates fall, they take advantage of it, but they can't cook the interest rates. Whereas borrowers do have a lot of control over the price for which they sell their house. And the design of the program that is discussed in the paper is one where you basically extinguish your debt obligation if you sell your house, if you can show that it's a transaction and you move out. Well, this immediately suggests, well, first of all, so it's basically a call option, and the call option has the following payoff function, right? Is, oops, basically you're at zero anywhere at any time that your house is worth less than the par value of the mortgage, and your payoff is dollar for dollar what the value of the house is above the value of the mortgage, the par value of the mortgage, if you sell the house. Well, there are two potential problems here. First of all, selling a house involves effort, particularly in an environment such as this one. I'm right now in the middle of selling a house in Bethesda, Maryland, which is not the worst place on earth to have to sell a house, but nevertheless, we have to do all this staging stuff that I guarantee you 4 years ago would not have been required for us to sell the house. We could have put a sign out front and it would have gone instantaneously. And the reason it's important is, of course, 4 years ago, there wasn't really an issue, right, as house prices were going up. But now is the time when you really want people to make an effort to get the most that they can out of their house when they sell it. Well, if you extinguish the obligation by just allowing people to have a sale transaction and move out of the house, they don't have the incentive to put effort into selling. And second, I was listening to Paul Willen's comments about fraud. The potential for gaming here seemed pretty obvious to me. It's just, why don't you trade houses with someone at a very low stated price? So I know the value of my house is worth less than my mortgage. I have a neighbor who's in the same situation, and we say to each other, let's buy each other's house for $1, and we'll go down and record it, and then that, again, is a payoff. I've moved out of the house. I've moved across the street, and I've extinguished my obligation. So this strikes me as a pretty serious structural problem with this as an idea, because the only value of the option to the borrower will come when there is distress in the housing market. And when there's distress in the housing market, you could have all these kinds of problems. So as I said, this one I wasn't so crazy about. The second one I think is basically fine, the variable maturity mortgage, but I just don't know how effective it is for a couple of practical reasons. First, the authors note themselves that they have to deal with one potentially problematic feature, which is negative amortization. They put it slightly differently, is there's a limit to the maturity that they would want, but there's a point where you get into a negative amortization feature, and I think we have decided, I hope we've decided that we're not going to do negative amortization loans for a while. Even in the Latin American context with lots of inflation, when they tried dual index mortgages in the 1970s, they didn't work out pretty well didn't work out particularly well from a loan performance standpoint. But the thing about it is it kicks in really fast. So if you start at a 6% loan, interest rates only have to rise to by 126 basis points in order to get to the point where it's an interest-only feature for the loan, because that's what the mortgage constant is on a 6% loan. And of course, interest rates can move a whole lot more than that in a fairly short period of time. Go back to the late 70s, they moved substantially more than that. And if you start at a rate of 10%, so looking at in the future, imagine we're in a 10% rate environment, it's only 61 basis points at which you reach the limit. So there's, I think, sort of that practical problem. And then the interest rate risk issue. I'm just curious. I don't know accounting well enough, and so maybe this isn't a problem, but it seems like the natural funder of these would be a bank because they're variable rate mortgages, right? That's what banks do, is they fund variable rate mortgages, but these would create balance sheet problems. So imagine a bank with a simple balance sheet that has assets of $100 of mortgages and $90 in deposits and $10 in capital, okay? Well, on 6% mortgages, you're going to get a payment of $7.26 a year. I'm doing annual amortization, by the way, not monthly, but it doesn't matter that much. So suppose depositors get 5%. So interest expenses that the bank is paying to depositors are $4.50 a year, and suppose the G&A expenses of running the bank are 25 basis points. Okay, if interest rates stay constant, what this means is the cash-on-cash return is about 25% on this deal. Okay, now, what if interest rates rise 1%? That 1% rise, their cash flow coming in stays the same, but they're going to have to pay depositors more. So their cash-on-cash return on capital falls to 16%. Well, how are shareholders going to react to that and the equity in the bank? Are they going to cut the value of the bank by a third, in which case raising capital is more expensive, and so on? So GAAP income is the same, but will shareholders be okay? And that's, I guess, an empirical question. Okay. As for the balance sheet side, of course, as interest rates rise, the amount of mortgage redeemed falls. That's baked in the cake of this program, which means that for a given level of capital, the bank can't do as much lending if they have these on their balance sheet. And again, is this a material constraint? Okay, finally, the covered bonds idea, I think it's a really nice idea, and in general, it has good features, and there's really not a whole lot I can complain about. But they use as an analogy, and Dwight sort of does this in his paper too, looks at the successes of government insurance programs, and I tend to like government insurance programs. I was raised in a household with parents who revered FDR, and despite a PhD in economics, that's never been really kicked out of my head. But while FDIC has been a great success, and I would agree FHA has by and large been a success, FSLIC manifestly was not. Okay, so government insurance programs don't always work out because of political issues. And even FHA, if you look at in some respects, some of the lack of innovations in the way it does underwriting relative to other institutions, things like developing automated underwriting systems, it may not be optimal. So let's not kid ourselves. Government programs often lack incentives to innovate or are subject to political risk. So just some bottom lines I would like to consider. First, when were things last really okay? Okay? And I guess others could pick a date, but if you look at the mortgage system in around 2002, it seems like things were pretty much okay. Okay, and so where were the problems that were lurking? And I do think the two problems, there were problems with Fannie and Freddie, but it wasn't the way that they underwrote mortgages. I think they did that quite well. And the evidence of that is if you look at the prime mortgages on Fannie and Freddie's book, I'm not including the Alt-A stuff now, the default rate on that stuff's about 60 basis points, which just, that's manageable, okay? So they seem to be able to know what they're doing with respect to that. I think the problems lay in two places, which ultimately manifested themselves in a way that has created some of our problems. One is they didn't pay the risk-adjusted cost of capital that they should have in order to raise money. That problem could have been solved with a program that John and Dwight have proposed, which is you add a Pagovian tax to the issuance of debt on part of Fannie and Freddie. And the second thing is about executive compensation, about which I could go on for quite some time, but it was clearly the wrong compensation scheme for anything that had some government backing. Two quick points. Third, I think there may be a virtue in simplicity. I think as economists, we tend to like to come up with clever solutions to problems. But I think it's complexity that to some extent has created the problems that we find ourselves in at the moment. So, you know, there may be an Occam's razor view to the world that we should think about. And finally, I think as we think going forward, I think we all agree we're going to continue to have government involvement in the mortgage market one way or the other. If you have any government-backed institution, should they be allowed to do any lobbying? I think is an important question going forward. And when we say that, we need to think, what is a government-backed institution? At the moment, it seems to me that Goldman Sachs is a government-backed institution. So thank you again, and turn it over to Richard.
Okay, Richard Roll.
Let's Let's see here. Well, my main comments will be about Professor Jaffee's paper, but I did want to just say a couple of words about Diana and Wayne's ideas, which when I first heard them, I thought they were very interesting and good. I noticed that Chairman Bernanke today in his remarks to us only mentioned a third of these ideas and skipped mentioning the first two. I'm not sure why that was, Wayne, but maybe he thought about the moral hazard problem that we just talked about in the first one. And I also want to point out that both of the first proposal, that buy your own mortgage and the variable maturity mortgages, there's nothing to keep the private market from doing that. So the fact that they haven't done the first one, for instance, makes you think that there might be a moral hazard problem that the market has recognized. And in the case of the second one, that has been tried. We've had ARMs back, I remember very well, ARMs originated with variable maturity provisions in them too. They haven't been very popular, but there's certainly nothing to keep originators from doing that now. But let me now turn to Professor Jaffee's paper, which is about regulating the investment banks and the GSEs after the subprime crisis. Dr. Jaffee's medical protocol is what I would like to term this. You know, basically he had a diagnosis and he has a prescription and a cure. So let me put it in that kind of a metaphor. He started out by saying that financial innovations cause crises, and crises evoke new regulations, and regulations have long-lasting benefits. And there are a few examples of these, although we could quibble about the examples that he gave. His current diagnosis is that losses on a relatively small asset class became magnified. How that happened, I don't know, and he talked about that a little bit. And the bailouts occurred because the Federal Reserve feared a meltdown of the entire financial system. So the treatment, re-regulate the financial system to make these events highly unlikely, to make systematic failure, or the prospect of systematic failure, highly unlikely. And personally, I think that's a good idea. You know, if that's the correct diagnosis, then the specific medicine is probably right. We need to organize financial firms into divisions where one can be a risk-taking division and one can be an infrastructure division that is bankruptcy remote, as he terms it. And if all financial firms were organized along those lines, it's probably true that there would be less danger of systematic meltdown. However, I think I can have some quibbles about various things. One is about whether or not regulations provide long-lasting benefits. Now, I came from maybe a different background, but what I learned when I was in graduate school, that there were lots of regulations that did more harm than good. Insider trading, you know, accounting rules that were created, and you forget that we had a lot of regulators that no longer exist, like the CAB, remember them? What about the FCC, or what about the Food and Drug Administration that prevents us from getting medicine when it's already been approved in every other country in the world? So I'm not absolutely convinced that you know, regulation in general is always beneficial, and sometimes it actually causes more harm than good. What about the diagnosis? Well, is it really the case this is subprime meltdown and the housing market which led to that? Is that the infection that caused a global pandemic? He talked about the doubts about that, and to tell you the truth, I have a tremendous amount of doubts. We've lost something like $10 trillion in equity market value in the whole world. I'm not sure. I mean, it doesn't seem to me very plausible that something as minor as a subprime crisis could have created this. And so I think we need to look for other causes. You know, Bob Shiller has a cause, you know, which is, has an explanation, which is a different diagnosis. There are other explanations that we ought to consider very, very carefully before we treat the patient with a medicine that isn't appropriate for the disease which they're actually infected with. So I think that, for example, we can consider the fact that just in this most recent period, private sector firms were unwilling to take comparable actions that he wants to propose. And I think, for example, that private sector firms were not willing to do things like debt equity swaps to reduce their leverage ratios, partly because they were waiting for the bailout to occur. So once the prospect of a bailout occurs, it impedes the private sector activity to do the very things that the bailout is going to lead to. And I think you can see that, firms are waiting now when they might have done things a few months ago that would have gotten them out of some of this trouble. He's right, I think, to correctly dismiss two alternative diagnoses of this patient. One, that it was securitization itself. As he pointed out, the final investors were the most sophisticated investors of the world. I think he's right also that rating agencies aren't to blame. As we all know, the rating agencies generally change their ratings after the market prices have already moved. So, the market already knows what the rating agencies know, so I don't think that's even a plausible hypothesis. Why a bailout? Well, the government feared a perturbation of failure should derivatives positions. We know that derivatives are in zero net supply. Maybe their fears were ungrounded. Maybe this all could have been unwound without any problem. And we do have a massive loss in stock market wealth around the world in non-financial corporations. Well, that suggests that there are other root causes. Well, an obviously root cause of a decline in value of a non-financial corporation is that the expected cash flows in the future have been eroded for some reason. What that reason might be is something that we should contemplate with more depth than just to blame it, I think, on a small perturbation in one sector of the mortgage market. Well, the prescription is that the losses on the hedge fund division must not threaten the viability of the infrastructure division. Well, why not just dictate entirely separate firms instead of just one firm which has two separate divisions? The regulations could do that. And Dr. Jaffee's answer is because there are efficiencies involved in having these two divisions overseen by one firm rather than having two separate firms. Well, you can ask a question about that. Is a bank less efficient if it's forbidden to sell insurance? I don't know. It's forbidden to sell insurance now. Does that make the bank less efficient? I don't know. But on the other hand, there's a special prescription that's going to be administered to the GSEs. Instead of having two separate divisions for the GSEs, they're going to be two separate firms. One firm is going to be the securitization arm, which would be a branch of the government. The other firm is going to be the retained portfolio arm, which would be a private. So the medicine that's being administered in that particular case is not the same medicine that's supposed to be administered in the cases of other financial institutions, which may cause you to wonder a little bit, at least that. So it's an alternative diagnosis, perhaps, which leads to a different set of medicine. Let me go, though, to the final line. Would this, if the government adopted these re-regulations, what harm would it do? Actually, I don't think it would do all that much harm. It's probably not all that inefficient. I don't think that the GlassSteagall Act, created gross inefficiencies in investment banking and banking. But I think what will happen is if this medicine is taken, that we will have something in history that will be like the GlassSteagall Act. The patient will be a little bit in discomfort for the next few years, and then the regulation will be repealed because the acute illness will be forgotten. So I do think his treatment is certainly a lot better than most alternatives. For example, nationalization of financial institutions such as the GSEs, which are one possibility that Chairman Bernanke mentioned this morning. Thank you.
Okay, our last discussant is Larry White.
And I'm the guy who's standing between you and something that's cold and has some degree of alcohol in it. All right, let me first try and find my set of slides here. Okay, and where am I? Here. Huh? Why do I not see me? I'm really worried here. Always bring along my own flash drive. Sorry. Sorry. Anyway, let me give you my standard disclosure statement while we are waiting. Anytime.
Which one is that, sir?
Oh, there we go. Sorry. It will be there. I assure you, it will be there. There you go. All right. And
Which one?
the Hancock. There we go. Hancock, Passmore, and Jaffee.
This one.
There we go. Yeah. Good. Great. That's the highest tech thing I know how to do. My standard. Sorry. Oh, by the mic. All right. I was a cheerleader in high school. Do I really need? All right. All right. Anytime Fannie and Freddie come up, I have to feel I need to do a disclosure. 20 years ago, as many of you know, I was one of the 3 board members of the Federal Home Loan Bank Board, and in that capacity, from November of 1986 until August of 1989, I was one of the 3 board members of Freddie Mac. When the Congress passed the legislation that redid everything, I happily returned to NYU and have had no such position since. All right, very pleased to be here and talk about these important topics. And to start things off, can you read that in the back? Yeah. Wish I was as clever as David Frum, who, as many of you know, was a speechwriter for President Bush in the first part of the current administration. You know,
we'd like to hear you on YouTube. So.
All right. The shapers of the American mortgage finance system hoped to achieve the security of government ownership, the integrity of local banking, and the ingenuity of Wall Street. Instead, they got the ingenuity of government, the security of local banking, and the integrity of Wall Street. All right. So having said that, as any good business school professor has to do, got to tell you what he's going to say it, and then say what he said. First, I want to just quickly remind you, many people in this room are familiar with housing policy, home ownership. Since we're talking about mortgages, it's really all about housing policy and home ownership. And, you know, U.S. housing policy, widespread subsidy of housing consumption through everything from income tax breaks, breaks for builders, breaks for renters, the GSEs, government explicit, up, down, and sideways, and as a New Yorker would say, too much is never enough. Now, there is a good argument for encouraging home ownership. There's good, solid theory, and in the last 10, 15 years, there has been developing a growing body of empirical evidence. Richard was one of the early contributors to, or co-contributor to this empirical evidence. So the story is good and has support. But as we need to remember, home ownership is not for everybody. You need to have stable income. You need to Remember, this is a big illiquid asset. It's hard to move. It restricts labor mobility, so it's clearly not for everyone. And of course, if we think home ownership is a good thing, rental subsidies do exactly the opposite, and they encourage more consumption of housing, and it is an inefficient way of subsidizing income. What are the consequences of all of this? Well, because it is such a broad brush a set of policies, it mostly just subsidizes people who would buy anyway, to buy a larger home with a 5th bedroom rather than a 4th bedroom, a 4th bathroom rather than a 3rd bathroom, and half an acre rather than a 3rd acre. It encourages sprawl. And where's the social benefit of that? There is some benefit in getting somebody who would otherwise be a renter to go over and become a homeowner. Again, it's all got to be done appropriately, but where's the benefit in too much consumption of housing? And in fact, we do invest too much. Ed Mills, my former colleague at Princeton, did some nice work for the Philadelphia Fed about 25 years ago on this. People have replicated it since then, and we invest too much in housing, not enough in other kinds of assets. Productive assets, that means physical assets, plant and equipment, but it also means human capital as well. The income distribution consequences are not what most of us would like, because it mostly goes to benefit high-income households. It's just not focused, what we do is not focused where we'd like to focus, which is on that margin of trying to encourage the low, moderate income household who isn't yet a homeowner to cross over and become a homeowner. Again, it has to be done carefully, but if there's a benefit, that's where it is, not in the 5th bedroom or the 4th bathroom or the extra 1/6 of an acre of real estate. All right, now I'm going to talk briefly about the 3 papers. As you've heard, they've got the BYOM option, which is a more limited version of the Danish system, the VMM, and the mortgage bond insurance, which, as they indicate, encompasses the idea of covered bonds. Why are they doing this? They want to avoid the costs of foreclosure. They want to sort of think more about the interest rate risk, and making explicit what has been implicit. All right, first, on the first one, BYOM. There may be ways of getting the Danish system or something approximating it without having the uniform securities that the Danish system has, which might be using some substitute. Like a Ginnie Mae security or some index of Ginnie Mae securities. Notice I say Ginnie rather than Fannie or Freddie, because who knows what Fannie and Freddie are going to look like in a couple of years, but fairly likely the Ginnie will be around. I've been scratching my head on this question of whether having the BYOM option priced into the mortgage is the right way to go about it. We do know that having the prepayment option priced into mortgages is not a good way to go, because everybody's paying for it. You'd like instead to have some kind of explicit prepayment penalty. So is there any way of having explicit pricing, or do we think of this thing as more like an insurance policy that everybody should be taking out? And in an insurance policy, the size of the deductible influences the price of the insurance policy. Down payment is like a deductible. Maybe that is the right way to be thinking about it. I couldn't quite figure it out, but I urge you, clarify this point for us. I've been sort of, was puzzling about VMMs, and Richard just told us, well, it has been tried before, so, that turns out to be moot. What about covered bonds? Well, in some sense, they already do exist. If Federal Home Loan Bank advances to member institutions are basically like covered bonds. And if you think about what a repo is basically a very short-term covered bond. Something that hasn't been stated, and a reason why the FDIC was so slow, and I think we really do need to understand what's going on here is that covered bonds do increase the FDIC's costs, because what it means is that the holder of the covered bond can get in there and grab the collateral before the FDIC gets around to cleaning up the institution. Ed Golding and I wrote about this 20 years ago. It is a genuine problem. Wouldn't government bond insurance be yet another broad brush subsidy for housing? We heard the chairman this morning talk about how there needed to be some government support somewhere in there for finance of housing. I guess I'm just not yet convinced that that really has to be so. To me, that just feels like another broad brush subsidy. Why do we want to do that? Why don't we really think hard about where we want the subsidy really to be? What about the Jaffee paper? All right, as you heard, he's got the hedge fund division and the infrastructure division. Why does he propose a separation? Because he's worried about the losses from the one, and he likes the analogy of Monoline. All right, first, the terminology. Most of us don't know what a hedge fund really is, and I'm just wondering if the terminology is really good. Is financial intermediary a better terminology? I don't know, but think hard about the terminology. Does infrastructure division really help describe? Also, I wonder, is it really a useful distinction when the infrastructure division that's dealing in derivatives, when it's taking a position, especially when you're writing derivatives, you are acting like an insurance company, which is a financial intermediary. Is this useful? Now, I like the idea we've got to do something about the regulation of financial institutions that can create systemic risk, and you're going to be hearing at the end. But I don't think a separation is the route to go. All right, first you've got, I don't think it's neither necessary nor sufficient. AIG failed and was a systemic problem because of the infrastructure division. It was writing credit default swaps, and that was the problem. With Lehman, once Lehman went into bankruptcy, that's what it was, the financial intermediary that turned out to create the systemic cascades, because the reserve fund holding Lehman commercial paper had to break the buck, which then leads to a run on money market mutual funds. It doesn't feel like a good distinction. Fannie and Freddie failed because they had inadequate capital, because credit losses on both sides were a problem for them. Let's just remember, systemic problems come in two flavors: contagious runs by perfectly informed depositors, cascades of leverage failures, and it feels to me like either side of these complex institutions can create these kinds of problems. So what do we need? Well, prudential regulation is necessary, and if you didn't notice this morning, Bob Hall wants risk-based, or wants capital requirements. They ought to be, to the extent we could do them, risk-based. But what he didn't say, and what's terrifically important anytime you've got capital requirements, is you need a proper accounting system, because capital is simply the arithmetic difference between the value of the assets and the value of the obligations, fixed obligations, and accounting is everything, and what we need is market value accounting. But that alone isn't enough. We need activities limitations. We need managerial competence requirements. We need an adequately staffed, adequately trained, adequately paid group of examiners and supervisors, and clear powers of receivership. There's a question, and I haven't figured it out. If we're going to have prudential regulation for these non-depositories, do we do it only for the biggest guys, or do we want to extend it to every little hedge fund in the land? I could see the story about a run on hedge funds, ill-informed creditors, but I don't know the answer. As far as Fannie and Freddie, again, why keep the securitization function inside government? Why don't we instead really truly privatize Fannie and Freddie, and then do focus on the real social value? I'd expand it. I'd be willing to accept some mistakes, but really socialize that real social value. If you think about what happened to railroads in the Northeast, eventually Amtrak staying within government, Conrail for a while in government, and then going back out to the private sector. That may be a model to be thinking about. And so, in conclusion, these are both interesting, provocative papers. Housing policy is going to be with us for a long time. And I urge you, read the papers. Thank you very much.
Thank you, Larry. Okay, we've got 10 minutes left, and I promised each of the paper writers that they could have 2 minutes. I'll knock that down to 1.5 minutes, and why don't we start with Wayne?
First, I'd like to thank the discussants for the comments. So I'll be very brief. First, for Richard Green's comments, I'd like to say, we just generally agree with them. We do discuss the gaming problem somewhat in the paper. There are perhaps other ways to handle it. For example, you might just turn the house over to the lender, let the lender do the sale. That might solve some of these problems. As Larry indicated, you might use indexes. There might be ways to mimic the Danish system. You might use something like an index of home prices for the locality and use that as a way to mark the home to market and then turn it over to the lender so that the home buyer isn't determining the value. So I think it is a problem, but I don't think it's an insolvable problem. And in contracts, I don't think it's really that bad. In the variable maturity mortgages, this really comes down to what are the savings in the mortgage rate. And we haven't quite gotten to the point where we have a set of simulations. We want to talk about exactly how much you might save. However, I would just note that, as you can tell in pricing the option, that if you have a lot of the comment is correct. I mean, basically, if interest rates fluctuate within 1% of the mortgage rate, basically the home buyer is picking up that part of the fluctuation, and if they fluctuate extremely, then the lender's picking that up and embedding it in the sense that they have to buy hedging instruments to hedge that. And so it sort of depends on what the volatility of the rate is and the like, and so you might, typically I think, it's 100 basis points for the prepayment option or something like that, 160 to sometimes as low as 40. It all depends what period you're looking at. But suppose you knock 25 or 50 basis points out of that. I would argue that's still something to be considered. Richard Roll brought up the question of, well, why aren't these things around? I think that's, and I would just say that they are around in other countries, both actually in certain forms. And they have been around in different forms, actually, not the BYOM in the US, but the VMM has been around. And new contracts get used when needs arise for them and people consider these things. Finally, just on the covered bonds, I think that the question of, could we mimic, well, Larry mentioned the thing about the mimicking. Oh, the FDIC, that was it. So the substitution of the FDIC, well, that's one reason to have the bond insurer is that, in particular, if the bond insurer, in a sense, was the FDIC in both cases, they would equate, supposedly, the risks and also take care of the substitutions that were going on between deposits and other forms of secured lending with government backing.
Dwight?
I want to thank all the discussants. Very quickly, Richard Green commented that the FHA was slow to innovate, and that's absolutely true. Actually, it's what I think you want. You want your government insurance company to be really conservative, to keep it plain vanilla, and then if there's a lot of bells and whistles, that's what the private market should be doing. So I think that's exactly how I want the government insurers to be operating. I want to thank Richard Roll greatly. I thought those were very constructive comments. He gave the paper better than I did, I think. I like the 3-minute summary with the medicine. And particularly at the end, if you didn't catch it, what he was basically saying is that by separating these two divisions, you have two goals. One is you're allowing the infrastructure, the protected part, to be safe, but you're also letting the hedge fund be unregulated, and that's really an important part. And I think there's going to be pressure to regulate hedge funds, and I want to be clear, I'm on the side of leaving them unhedged, no, not unhedged, unregulated, unregulated, even if they're unhedged, because they, I think, serve a useful economic purpose. I won't go over the other detailed comments, but I don't think we're far separated on those. Finally, Larry is quite right that I should be much more careful about defining the infrastructure division. In the case of AIG, I would say that in a counterparty, it's the market maker that's in the infrastructure part. They should have a balanced book at the end of the day. If the company as a whole wants to take a position, they want to be short or long on credit risk, that goes over to the hedge division at the end of the day, and that's fine too, but we want to protect the market maker function is all I would say, but I should define that more carefully in the paper. We'll have to talk. Fortunately, I'm visiting at NYU, so I'm going to get to see Larry all next week, so we can talk about why you think Fannie and Freddie should be out in the private markets. We'll have to talk.
Okay, I think we've got time for one or two questions. Go ahead, Chris.
Quick question for Wayne and Diana, which is the federal home loan bank system does provide a lot of liquidity. Banks have drawn enormous amounts of credit from it at times, but it doesn't seem to be an incremental source of credit for housing, which is sort of the puzzle to me, why I don't quite understand how it works relative to covered bonds, because banks still have access to that and could put mortgages into it, but they don't seem to be originating lots of mortgages to go into the federal home loan bank system. So I don't know if you could clarify the relationship between that and what you sort of envision covered bonds being.
So actually, we actually have a paper on the federal home loan bank advances and how banks actually, money is fungible. Once you've put your mortgages up for collateral, you can then take that money and spend it on C&I lending. You're not restricted to actually fund mortgages. You just need to have them as collateral. So I think that's a big distinction between using federal home loan bank advances and a cover pool situation where the actual pool has to be of a specified type of lending. Maybe it be MBS and mortgages. So they're really distinct in how the one is very much tied to a particular pool of assets, whereas advances, it's just a collateral.
Okay, we have one more question.
Yeah, on the BYOM, excuse me again, how is that different from a short sale? And on the covered bonds, I think those are interesting, but those are essentially securitizations with a senior subordinated structure. The issue in a lot of countries is that when you do the real securitization and go through a trust, you have bankruptcy remoteness. And I guess one question is how do you solve that?
So on the BYOM, I'm sorry, Bob, say it again. You were interested.
They have the same things as short sale.
So it is the same. It's a ex ante contractual way of doing the short sale. That's all it is. I mean, it's a way to price it up front. It's de facto sort of home price insurance for the homeowner, and it's a way to try to have a ex ante contractual approach versus a foreclosure.
It's a workout, continuous workout.
Yeah.
Mortgage.
What it does mean, I think, is that everybody who has negative equity, in effect, defaults. And that's okay if it's priced fairly, but it's got to make the rates way higher.
Well, no, so hold it. Well, perhaps. I mean, you know, it all depends what you think. I mean, you're right in the sense that if Richard's right and everybody just goes and trades houses, we all have a trading house day, then it might do that. But I actually think that the requirement that one that you know, I mean, I do think the attachment to the home is a little greater than that, and particularly you have to move out, and you lose any opportunity to recoup the down payment. So if the down payment was substantial, so it is. There are reasons you might not do that. Furthermore, we discussed in the paper there might be additional contractual things such as DTIs and the like that you might put on that would make it so that the moral hazard consequence would not be as big. What?
It'll still hit your credit history.
Well, you might actually have as part of the contract that it doesn't. I mean, so.
You can't put that in a contract. Your credit information is collected in a separate way, right?
Well, I mean, we're talking about a legal framework here, a suggestion. So, Then as far as the, I'm not sure I quite understand the question about the covered bonds, because it's not formally a senior and subordinated framework, except that, of course, the bank is putting the over-collateralization in and therefore taking the junior position. Now, the difference is that, it's a heavily monitored. I mean, in European countries, that is, investors take it that the bank supervisors, the government bank supervisors, are certifying that over-collateralization. So the government plays a key role in making that covered bond system work. And you could argue whether this is an implicit or explicit guarantee, but as we've seen in the recent past, it's pretty explicit, really. And so, that's why we're arguing that in equating these different ways of financing, you need sort of an entity that's going to risk adjust prices through premiums to make sure that the institutions that are using them decide how to use them, not based on competing with implicit guarantees, but based on what's the best for creating greater mortgage credit.
All right, well, I would like to thank everyone on the panel and hand it off to John.
Well, I want to take this opportunity to thank all of you people for flying all across the country and coming across the campus and spending 2 days thinking about these issues. I want to thank the presenters, the discussants, the panelists, the session chairs, a couple of institutions that are, besides the ones that Stuart and I have responsibility for. There's the Center for the Economics and Demography of Aging that helped to support this, the Fisher Center at Haas, as well as the Haas School, the Goldman School, the Economics Department, and the Anderson School and the Law School at UCLA. So that's everything. Finally, I wanted to thank Brian Gothberg for spending a vast amount of time trying to make this thing work. And Larry Rosenthal, who really was involved in every stage of the operation, from the intellectual design through the execution, through the TV, satellite, and all the other things that could have gone wrong. Thanks very much for coming. We hope to do something like this again in the near future. Thanks.